Today we're excited to share a new, concise video that breaks down some of the most talked about provisions of the recently enacted One Big Beautiful Bill Act. This legislation introduces significant changes that will impact a wide range of taxpayers, and our short video aims to highlight a few key areas that are already generating quite a buzz. Let's get started.
Well, welcome to the brief update from Back to Basics on the One Big Beautiful Bill Act. Actually, the name was changed at the last minute, but that's what everyone knows it as before it ping-ponged back and forth between the Senate and the House. I'm just going to hit a few of the highlights as we go through. The main part of the provision, as far as tax-related is concerned, is provisions inside the Tax Cuts and Jobs Act were made permanent. Now, there's a few modifications. We'll hit some of them here. And the first one that was addressed was the extension of the SALT limitation, but they've increased that from $10,000 to $40,000. It comes with some phase outs, and we'll talk briefly about that as well. There's also a new provision for interest deduction on loans for the purchase of vehicles. So it has to be a new vehicle, and we'll get into those details in a bit. And one of the reasons I want to spend some time talking about this before some of our fall seminars, this is time-sensitive material when it comes to the reduction or elimination of some of these energy credits. A lot of the green credits that were put forth in the Inflation Reduction Act are going to terminate, some before the end of this year. There's also some provisions in there, again, not tax-related, but inside this bill, it calls for $85 million to be allocated to move the space shuttle from Washington, D.C. to Houston. So $5 million for the transportation and the rest to build a new facility. If you ask me, if you're looking at cutting back on government waste, the space shuttle's good in Washington, D.C. But be that as it may, here's my focus today. The main area is some of the campaign pledges. We've heard a lot about no tax on tips, no tax on overtime, and no tax on Social Security benefits. There's a lot of misinformation out there, misunderstanding by quite a few. So I'm focused on these three main areas to give you some details, especially if you're looking for some talking points with perhaps some of your clients. Tip income and whether we can exclude that or not. Well, it's a deduction. So it is a temporary fix, not a permanent tax law. You'll see that as we get into the seminars, there's a lot of provisions that are permanent, some are temporary, and this falls under that temporary label. So it's a deduction for individuals that it's not for everyone, because if you're highly compensated, we'll give you those thresholds. You have to phase this out, and it could be eliminated depending on your adjusted gross income. So it starts this year, goes through 2028, and then it sunsets, like many provisions that are written. So there's no tax on tips. How much? Well, it's up to $25,000 per year, regardless of your filing status. So if you're single, up to $25,000. If you're married filing joint, it's still just $25,000. Another question that someone asked me the other day: what if perhaps the husband works construction and he has all the overtime and he has $20,000 of overtime? The wife doesn't have any overtime where she works. You'd still get the $20,000, the full amount, up to the $25,000 for married filing joint. And again, this is a deduction, and it's not above the line. It's referred to as below the line, which means it's not going to affect adjusted gross income. Some things in the tax world, AGI has some restrictions. Example, for medical, 7.5% of your adjusted gross income is a haircut. So it's going to reduce taxable income, but not AGI. So it's specifically where it comes in the tax return makes a difference. If you're a self-employed individual, you also get this deduction, but there's a caveat. The deduction is limited to the profit from your activity. So let's say that we have an individual that drives Uber. So he's in the gig economy. He gets tips in the normal course of driving people to and from the airport. In that situation, you have to take a look at what is the income from the activity. Here, we're also looking for some more clarification, but they haven't defined what income is, if it's just the net amount on the bottom of the Schedule C, or if you're taking into account the deduction for one half this self-employment. So we're going to have to wait for some clarification there. But bottom line, it's available for self-employed individuals, but there is a limitation based on the profit from the activity. If they have a loss, obviously they're not going to get any adjustment there. It's basically for qualified tips, and that's defined in as cash tips. Now, cash tips also includes credit card if you have a tip sharing program. But here's the caveat when it says qualified tips. It has to be voluntarily paid. It's something that can't be negotiated and it's not required by policy. So if there's a restaurant that charges a 20% mandatory gratuity, if you have a party of 6 or more, that's not a voluntary tip. So here's the tough part. For payroll purposes, the employer is going to have to identify what's qualified and what's not. So maybe a server had 3 tables with 6 or more people with a mandatory tip. That will have to be carved out, so it won't be allowed as part of this deduction. So another area where there was when they first talked about this during the campaign last fall, a lot of individuals are saying, I'm going to change the way that I charge. Perhaps you're an attorney that wants to charge a flat fee to represent someone, but then there's a gratuity on top of that. They specifically deny this deduction for anyone that is in an SSTB, which is a specified service trade or business. So your attorneys, your accountants, and doctors, anyone in healthcare fall under this category where even if they did get a tip and it was reported to them on a W-2, they still would not, by default, get that deduction. Now, I said that there was a reduction. It's not available for high income individuals. So here's how they define that. 150,000 for everyone but married filing joint. So married filing joint couple, they would get the double that amount at 300,000. Once you exceed that modified adjusted gross income, you have to reduce this amount by $100 for every 1,000 that you exceed modified AGI. Essentially, that's adjusted gross income, adding back foreign earned income, housing exclusion, and foreign earned income exclusion. So for most people, it's going to be their adjusted gross income, but that's the threshold, what they consider high income individuals. Here's again the toughest part for those accountants that do payroll or payroll services, and for employers that have to get that information to the provider of the information return. To get this deduction, it has to show up, and they're going to have to, again, modify the forms either on a W-2, a 1099-K if that's issued, a 1099 NEC for non-employee comp. That would be perhaps your Uber driver, or perhaps self-reported on the 4137 when you're reporting your half of the taxes for FICA purposes. Now, again, we still need some clarification. We know that the 1099 NEC threshold is $600. If it's less than that, they don't report a 1099. Well, let's say you just got into your business at the end of the year and you got a basically income of $500 and there's a tip in there for $50. Do you get the deduction? How do you get that when there's no information return reported at all? So we need some clarification on some of that going forward. No tax on overtime. Again, a lot of misconception, and I want to set the story straight as far as how it's calculated. I've talked to a lot of people in the construction world that believe once you work overtime, it's all tax free. And of course, the devil is in the details. It just doesn't work that way. Again, like the no tax on tips, no tax on overtime is a temporary deduction. So same period here, 2025 through 2028. Again, another deduction, but phased out for highly compensated individuals. In fact, if this slide looks familiar, it's the same numbers that we have for phase out for no tax on tips. You reduce it for every 1,000 of modified AGI by $100 if you're over 150,000, or double that for married couples filing joint. The deduction amount, what can you get? Up to $12,500 if you're married filing joint. Of course, it's double that for qualified overtime compensation. Qualified overtime means overtime comp paid under the Fair Labor Standards Act of 1938. So brush up on your history, folks. What are they saying here? Generally, when we're talking about qualified overtime under the Section 7 of the Fair Labor Standards Act, you're talking about someone who works over 40 hours a week and they're required to be paid time, at least time and a half. So it's the incremental part that you're looking at. So what does that mean? Well, let's say that under collective bargaining, they work out some type of agreement through the union and the employer that overtime starts at anything over 35 hours. Oh, that doesn't mean if you work 37 hours, you don't get this deduction. If you're looking at certain states, California, I believe, has a rule for overtime at the state level that if you work more than 8 hours in one day, you get overtime. So if I work a 10-hour day, that's 2 hours of overtime. That doesn't meet the definition for Fair Labor Standards Act. If my entire work week, I worked a total of 10 hours for 3 days and I only worked 30 hours, 3 days, I didn't go over 40 for the week. So it's the amount that exceeds the regular rate. And this is where there's a lot of people that get this wrong. It's just that rate differential that we're talking about. So if I'm dealing with an individual that makes $30 an hour and their overtime pay is time and a half, so I get paid 45, that incremental difference is not the full $45 an hour. We're talking about the difference of $15. So that's the amount, the 0.5, not the 1.5, the entire amount of overtime pay. To be able to get this, you're going to have a work eligible Social Security number to claim that deduction. So ITIN holder would not be able to get this. The Form W-2 has to also disclose what is qualified overtime pay by this definition, just like we have the similar requirement for the no tax on tips. So here's the example that I talked about. The incremental part is the amount that qualifies for the deduction on the individual's tax return. All of the income that we're talking about, whether it's tips or the overtime pay, everything for payroll tax purposes remains the same. So the employer is still going to go through that entire calculation like they always have on overtime and tips. You can't deduct it unless it's reported on the information return. They also have a provision in there that prevents someone from double dipping. If you have a qualified tip, you can't also claim that as a qualified overtime compensation. So you can't deduct the same dollars twice. That requirement that I talked about for Social Security number, it has to be issued before that tax return, including extensions. So if someone has an ITIN, but they're eligible to get a valid Social Security number, you may have to put the return on extension to be able to take advantage of this provision. Filing status, no tax on overtime. Married taxpayers have to file jointly unless they're considered unmarried. So if they don't live together in the last 6 months of the year, that would be the exception. So for married taxpayers, unless they're considered unmarried, must file a joint tax return. Here's the problem that we have additional questions on. Of course, there's a lot, at time they come out with any tax provision, there's always additional questions. What are the states going to do? Are the states going to follow this? If so, which ones? And are they going to have the same type of exemption? So we're not only looking for clarification from federal, but on overtime and qualified tips, but also how are they going to handle that at state level? State tax impact, again, how are they going to require reporting for W-2 and 1099s? So we're looking for additional guidance. As soon as something comes out as federal, now everyone has to scramble to react. So watching the updates will certainly be important for that. Another area that a lot of people have this misconstrued, and I understand the confusion here, is no tax on Social Security. Even the Social Security Administration sent out an email saying that it wasn't going to be taxed. But here's the clarification part that most people are not aware of. The bill does not change Social Security taxation calculation at all. The same calculations are in place. It's a temporary fixed just like we had for the tips and the overtime. This is for the same years, current year 2025 through 2028. This amount that we're talking about, it's called a senior deduction. Basically, it's an additional $6,000 per individual that's over age 65. So actually age 65 or older. I want to make sure that I'm clear on that. This again reduces taxable income, but not adjusted gross income. So it will come in after AGI as an additional deduction. What does this mean, or how are we saying it's not eliminating the tax on Social Security? Well, here's an excellent example. Let's say that someone retires early at 63, starts taking a reduced amount of Social Security benefits. They also have some additional income, and the calculation, as I said, is going to be the same as it always was to determine if 50 or perhaps 85% of their benefits are subject to tax. We have a situation where that person would not get the $6,000 deduction. They're going to be taxed the same as they normally would have. The benefit to them will be when they get older. Once they turn 65, they'll get the additional $6,000 again, but a temporary fix that goes away. Also, it's not for everyone that collects Social Security. I've had a client that had retired collecting Social Security, and the AGI was north of $800,000. He's not going to get this. The deduction's reduced by 6% of modified AGI to the extent it exceeds 75,000, or if you're married, double that at 150,000. So if someone is low income Social Security recipient, they're probably going to get the full benefit of that $6,000. But know that there is a phase out for high income individuals, and this number is a little bit different than the thresholds we had for the no tax on tips and the no tax on overtime. Filing status, just as we had rules before, if you wanted to take some type of an exemption or the calculation benefit for married taxpayers, they must file joint. If you file married filed separate, it doesn't fly. The only exception again is if you're considered unmarried. Again, you live apart for the last 6 months of the tax year, then you can be considered unmarried. So filing status is important on this one as well. A couple other individual provisions that I want to make people aware of. The new bill increases the amount of non-refundable child tax credit. So they bump that up from $2,000 to $2,200 per child. So that starts right away. And going forward, this is going to be indexed for inflation. So for those people that have children, a perk there. It also makes permanent the refundable portion of the child tax credit. That's going to be sent again at $1,400, adjusted for inflation going forward. So a benefit for those people with kids. And the phase out that we talked about for this particular tax credit is locked in at $200,000. Double that for married filing joint at $400,000. And again, these rules are going to be kicking in right away. SALT cap, I alluded to that in one of my earlier slides. New rules for this effective for 2025. It's a temporary increase, though. It will go away in 2030 in this particular case. As I said, it went from $10,000 up to $40,000. And every year, it's going to bump up 101% from 27 to 29. After that, it reverts back down to $10,000. There's a phase out for this as well. So if you do have someone, and this will benefit those people, I can think of a few clients that have their main home and then they have a vacation property, and they're paying property taxes in both places. They have income tax. So this will help some of those folks. But if your income is too high, and by definition, that's at $500,000 for this current year, will slowly creep up. And this is the chart on how it goes up. The deduction cap and the modified AGI threshold will increase by 101% all the way through 2029. Once we get to 2030, it reverts back to $10,000. In other words, that will be someone else's problem who's in Congress at that time, in the White House. So we'll have to wait and see if they extend that. Once they give a tax benefit, it's hard to take it away, but For now, it's a temporary fix and will allow some more people to itemize. So years ago, before Tax Cuts and Job Act, I probably had about 80% of my clients would file the Schedule A. It kind of flip-flopped, and about 20% file the Schedule A. Now, I'll see that number go up. We'll see how much, depending on other thresholds as well. New personal car loan, I alluded to that in one of the earlier slides. The deduction for up to $10,000 of interest paid. Again, this is temporary from 25 to 28, but there are some provisions here. It's basically on the purchase of a personal use vehicle. Some people have asked already, what if it's a mixed use where I use it 80% personal, but 20% for business, or vice versa? The statutory verbiage basically indicates it's got to be personal use. We'll see if they change that with some regs as we get a bit closer to the end of the year. It's on a new loan. So if you bought a new car in 2024 and you're still paying interest on that car loan, that's not going to be deductible. This is for purchases. And again, it's always watch the effective date after the bill was signed. So it has to be new, not used, or leased. If someone takes out a lien to make, or I'm sorry, a loan against their vehicle that they're leasing, they can't take a deduction for that. They have to actually purchase it. The final assembly for this new vehicle has to be in the US, so they're going to have to track where the final assembly took place. How did they do that? Basically, it's going to be with the VIN number. They'll have a report that individuals will get when they purchase that vehicle. It's for manufactured on for highway use, so golf carts are not going to fly for something like this. And it has to have at least 2 wheels, so motorcycles do qualify for this. Gross vehicle weight has to be under 14,000 pounds. And I talked about that VIN number requirement. That form will have to be basically part of that vehicle information. I also believe they're going to issue another type of 1098 to track that type of interest reporting. So the IRS gets a copy, the taxpayer gets a copy. So wait for some of those to come out before the end of this year. Again, phase outs, it's not for everyone. If someone's modified AGI is over 100,000, double that for married filing joint. You begin a phase out. This is a reduction of $200 for every 1,000 or fraction thereof above that threshold. So get the calculators out. There'll be some people that have to shave off some of that deduction depending on the vehicle and the amount of the loan and their modified AGI. So where does it fully phase out? If you're talking about married at 250,000, say a single taxpayer at 150,000, completely phased out. I want to focus on these, and I've got a couple of things in red on the effective date because this is time sensitive. I go into some detail about a lot of these provisions, more than we can have time to cover here. But I wanted to get this information out because this is effective before most of my seminars are even started. If you're talking about someone, if you or someone you know is looking at getting a electric vehicle, whether it's a used one or a new one, the basically those credits are going to go away after September 30th of 2025. So if someone's on the fence about buying an electric vehicle, whether it's new or used, make sure that they start taking action now because you have to have it in possession. You can't order it in August and then take possession in October. You have to basically have it in your possession before September 30 of 2025. Energy efficient home improvements. If someone, again, is on the fence about whether they put in new windows, doors, energy efficient furnace, skylights, air conditioning, etc., this all has to be placed in service before the end of this year. So the clock is ticking. And I know if you're looking at putting in new windows, maybe the people that install those, they might be booked out for 2-3 months. So the pardon the pun, the window is closing for taking advantage of some of those green energy credits. The same thing for the big ticket items. Residential clean energy credit, which covers solar, fuel cell, geothermal, wind energy, that has to be in place, purchased and in place on or before the end of this year. So if someone signs a contract to put in solar, it's going to cost $70,000. That's a 30% tax credit. That better be installed before the end of the year or they don't get the credit. So that's something that people need to move on. Same with geothermal heat. That qualifies for perhaps a new home construction, but things take time and contractors back up. That's one of the things I wanted to emphasize, and that's why the effective dates are in red on these particular slides. Um, Now, for those people that perhaps have an electric vehicle and they want to install a charging station inside their garage at home, they have a little bit more time, but the window's closing on that as well. It's effective for purchases on or before June 30th of next year. So June 30th of 2026, as long as it's installed by that date, you'd be okay. But be advised that those credits are going away. Almost all of the energy credits at some point will be terminated that were in I believe it was all part of the Inflation Reduction Act. Other credits, as I said, new energy efficient home building credit. This is for builders who build essentially what's called a green home, an energy efficient home. That credit is another one. I'll talk about that in some detail in the business section, but be aware that a lot of these are expiring. Some estate provisions, they've increased that when we're talking about the unified credit for gift and estate tax purposes. It was at 10 million. That's going to bump up to 15 million per individual. Keep in mind, we still have the ability to do the DSU, so the deceased spouse unused credit. So husband and wife, if they do some proper planning, can transfer $30 million without having to worry about any estate tax. That's also going to be indexed for inflation going forward. So some adjustments there for some people that are high net worth. They might want to take a look at that as far as some estate planning. Business provisions, just a couple I'll hit briefly. The FICA tip credit, it's code section 45B. Basically, they're folding in more people that can qualify for this. Your barber, your hairdresser, nail salon, spa treatments. So those types of professions qualify now for the tip credit. Not the time or place to go into detail here, but I will, of course, during the seminars. Business provisions, enhanced flexibility for R&D credits. They allow immediate deduction, or you can take some options on how you want to amortize R&D costs. So a big win for those people that have those type of expenditures. They brought back the 100% bonus depreciation. So that's a plus for some individuals. You also have an option of keeping the 40%. We'll talk about when you would want to make that election. But for the people that maybe are in construction or buy a lot of equipment, a lot of expensive equipment during the year, a great tax advantage there. So some tax planning opportunities there that we'll touch on in business. They increased the Section 179 cap. So it's at 2.5 million. So I'm a bit dated, folks. I remember when it was a big deal when it jumped all the way up to $10,000, which is kind of laughable now. 2.5 million is the new cap for that. Code Section 199A, we're talking about qualified business income deduction. They've made this permanent because it was, again, like many of the provisions in the Tax Cuts and Jobs Act, was about to sunset, and they kept the rate at 20%. The reason I emphasized the 20%, a lot of people were talking about that bumping up to 23%. Well, that was the House version. Again, there's a lot of confusion on the internet who's putting out the information. It did not change. The House had a different version. This is the Senate version, which ultimately is the version that passed. So it's 20%, and there's a couple other tweaks to that, which we'll get into in the business session. Expansion of business interest deduction and how the excess business loss calculation is done. Permanent renewal of the Qualified Opportunity Zone program. So this allows people to perhaps invest and defer some of that gain on some of their investments if they're in a qualified opportunity zone. Too detailed to go into at this point. Employee retention credit. Boy, this has been on the news quite a bit because there's been so much fraud. So they finally threw out some potential penalties here. If an employee retention tax credit promoter, these ERC mills, were giving advice, helped to prepare a document, and it fails to comply with the due diligence, so they didn't do it right, they're subject potentially now to $1,000 penalty for each failure. So if they've been cranking out hundreds of these, that could really add up as a potential penalty. So we'll talk about the effective dates and who falls under that category as well. There's a lot of information that we haven't touched on here. They've made some tweaks to the qualified business stock, the Section 1202 exclusion. They've got some provisions in this bill for perhaps how you recognize the gain on the sale of certain farmland, tax rates, and how they are basically locked in now, but the two lower rates, the 10 and 12%, have been affected a little bit. Child and dependent care credit, they've made some changes there. The adoption credit, they've made some tweaks to the premium tax credit, some not favorable for those people that were receiving the premium tax credit and they had to pay some of it back. There used to be a cap. Well, that's going away. They tweaked, they opened up moving expenses a little bit for people in the intelligence agencies. So if you're in the CIA and you have to move, military was on that list. Everyone else is still the same. Alternative minimum tax, they've tweaked that a little bit where some people, because of the way that the calculation is done for AMT, some more people or high income individuals will be subject to alternative minimum tax under the new rules. Changes to the ABLE account, the Achieving a Better Life Experience, the 529 plans, what's eligible as far as what's qualified expenditures. One thing that stood out to me was some verbiage on you can use 529 plans to pay for credentialing. So if someone wants to sit for the CPA or perhaps the enrolled agents exam, they've got 529 plan money that can be earmarked for that as well as a qualified distribution. Charitable contributions, we brought back in this case some rules on what can be deducted for individuals and for corporations. There's a bit of a haircut. And for those people that give and don't itemize, there's the ability to put some money as charitable above the line. Wagering losses. So we'll talk about how that's calculated and what the limitation is. And perhaps one of the bigger questions that I get is how do these new Trump accounts work? Basically, we'll talk about the contribution limits. You can't contribute until after July 4th of next year, so 1 year after the bill was signed. There's distribution requirements when those kick in. The pilot program is basically the government's going to drop $1,000 into these accounts for newborns. And we'll talk about those. That doesn't kick in until 2026. We'll hit all the effective dates, all the exceptions, what the general rule is in all of our seminars. It's a lot to absorb. There's no doubt about that. And I think about the profession that I picked. I must think I'm smarter than Einstein because this stuff is a little bit more difficult to understand. When they talk about tax simplification, that's an oxymoron for sure. I encourage all of you to sign up for our seminars or webinars and go to the website. Obviously, the business will predominantly have the business provisions, and I'll break up some of the provisions in part 1 and part 2 for our 3 main seminars and webinars this year. So go on to Back to Basics website, sign up to get all of the details along with any other updates. Look for the newsletter to bring out some more clarification as it comes out. They just came out with the broad strokes, and when they come out with the regulations or clarification, we'll certainly add to that as well. Again, thank you for your time. We'll hope to see you at the seminars.